All right, everybody. Um, well, welcome to the first episode of the drive home with Alex Buriak. Uh, Decided to do something because make so much education and off the cuff uh, advice to everybody. I was like, you know what? I got some downtime on the way home. Why not fill it with some information for you guys to actually use to grow and scale your businesses, get some insight, get some real honest feedback. I'm not reading anything if I'm, driving. So, so we are on the road. So one of the things that you guys may or may not know about is that uh, the products that are coming out with long-term lending is actually getting pretty nice, pretty interesting. There's a lot of appetite for this space. And if you came to our Saturday teaching class, or if you come see me talk on the third Wednesdays or anything like that, you guys have probably noticed that I'll go into a lot of the DSCR type lending because when what was it, August 23, when prime went to 8.5, everything started to change and shift, and exit strategy started to change and shift, and even people that were trying to get 30-year loans started to change and shift. And that wasn't just the issue. Not just the rate, insurance quadrupled, property taxes went up, and how that paper works is basically this ratio. And the ratio is what's called the debt service coverage ratio. I'll kind of break it down for you real quick. So what it is that you take the rent, or projected rent, so call it $1,200. So if you're renting a property for $1,200, that means for a 1.2 ratio, your mortgage, your principal, your interest, your taxes, your insurance, and any association dues. Association dues are bigger than condos, like home associations and things like that. But condos, you really seem to have an issue with them. That can only be $1,000. So 1,200 divided by 1,000 is 1.2. All right, and that was pretty simple. But when values of properties went up, taxes went up, insurance was up and was difficult to get, the refinances started to slow down on the 30-year. You guys notice if you ever try to do a 30-year DSCR refinance, wasn't the easiest obstacle to go around over a little bit because there's always some sort of an issue with the ratio. But now we've come into a lot of great products that not only just use the DSCR, but they're able to do a lot of different types of calculations because the industry is very hungry for this investment real estate long-term paper. What does that mean for you? That means that things are getting easier, are really, really hungry for the investment 30-year paper or long-term paper. So it's a really good time if you're a flipper or if you're a landlord or something, actually coming in, getting us over here at Jet, because we actually have some really interesting products that can do for residential or commercial. For example, I'll give you some examples, some real stuff here. We had a borrower want to get a 30-year loan on a commercial project. Put in their information, just wasn't papering out. Well, there was another property that they had that could have been that was papered up, and it's in underwriting now, where they got cash out of $1 million to focus on their business, which is the reason why they were refinancing their business in the first place. So this paper that's out there is getting very, very hungry for residential and commercial space. We've seen it as low as 500 credit score. Now, if you're going to be in the 500s, your loan to value is going to be 60, 65%. Your rate's going to be much higher, but you have an opportunity. The best 30-year rates right now, really, 740 score and higher. You're getting the lowest rates. You're probably going to paper out, most likely, on your rate. Today is what? It's been August 26th all day. You are going to be probably, I'll call it like a 6.7, 6.8 to 7.5. If you're seeing some things out there where you're like, oh, getting to the 5s, getting the 6s, what that is that if you severely decrease your loan to value, usually like on cash outs and people don't want the full amount, there are opportunities, but very rare opportunities. So just watch that. Get some real terms going on, and so you can paper out your profit margins and things like that. So the DSCR papers is actually getting pretty interesting out there. So if you guys are investors out there that you're like, you've had some failures in the past, you had some struggles in the past, underwriting's getting like conditions that they're like, well, what's going on here? I can't get this done. Shoot it over to us. And let's see if we can actually get this thing papered down for you, because we're having some really, really good success getting people done. Now, one thing you guys have to understand, when you're working with a 30-year paper, I can't say nobody because I don't know everybody, but I know enough people. But most lenders out there today do not carry their 30-year paper on their balance sheet. Very, very rare. 5 or 6 really big institutions, call them institutions, because they're not all banks. Some of them are insurance companies and family offices and pension funds and large banks, right? So call it that. And what they do, they don't have a forward-facing lending outlet. What they want is to deploy their capital to other stabilized lenders like Jet Lending, and we help them underwrite the loan. We find the borrowers, we originate the loan. They take it and they securitize it and they sell it off into the market. That's why any of you guys have actually your own primary home or DSCR loan, all of a sudden you may get a letter in the mail that your note was sold. That's why. So when you're working and trying to scope things out with a lender, you got to understand most of these products are coming from the same institutions. So you might as well just get with a lender that's telling you straight and telling you what to do, and not giving you false hope, because it doesn't benefit us and don't benefit you either. So that's just the real interesting take on the DSCR side right now. We're having a really, really good experience with these lines, and I think you guys should capitalize on it, because if you guys have been having issues in the past, we're really not having those issues anymore. As long as you're truthful on your numbers, you tell us what you are, credit score wise and things like that, and so we can try to get you the right product. This is not the time to be like fudge the numbers up, fudge the numbers down, okay? Because if the worst case scenario works, it works. You know, like, you guys, if you've ever listened to me, I tell you to do 3 things. Work your numbers on the best case scenario, the worst case scenario, and the most likely case scenario. If you're making money in all 3, you get that property done. If one of them is off, you got to rework it, okay? You can't be one of those investors that says, oh, if this works, I'll be okay. Don't do that. That's what happens in pivoting and transitioning markets, is the people that said, oh, if this stays the way it is, I'll be okay. That's where you get hurt, okay? So don't do that, all right? So that's one of the things I want to talk to you guys about on this drive home, is that if you've been having issues on DSCR and stuff like that, time to take a relook. Okay, it's time to get it done because the papers out there is getting easier to handle. It's getting easier to have transactions, and there's more types of opportunities than there were in the past. Okay, that's for residential and commercial. I mean, commercial, like even apartment complexes and stuff like that, that was non-existent come like last year because everybody knew when prime went to 8.5 and the people bought their apartment complexes in 22. Well, not 22. They bought them in 19 and 20. Well, just to let you guys know, nothing happened to me. My phone started overheating because I think my car holder was getting too hot. Anyway, I'll end up with the what happened in 22. So when people bought the apartment complex and the commercial properties in 22, what happened was banks tend to lend off of not conventional when that